The week is about to draw to a close and we're opening a window at what next week has in store for the markets. On the monetary front, we note the interest rate decision of the BOC on Wednesday's American session and the ECB's interest rate decision on Thursday during the late European session. We also note the speech by BOJ Governor Weda on Tuesday, the deliverance of the UK's annual budget to Parliament on Wednesday, the post-interest rate decision speech by Lagarde on Thursday, and on Friday, US President Biden's yearly State of the Union speech. As for financial releases, we make a start on a slow Monday when we get Australia's building approvals rate for January, followed by Turkey's and Switzerland's CPI rates, both for the month of February. And closing off the day is the Eurozone Sendex figure for March. On Tuesday, we get Japan's Tokyo CPI rates for February and the US factory orders rate for January, and the US ISM non-manufacturing PMI figure for February. On Wednesday, we note Australia's GDP rate for Q4. On Thursday, we make a start with China's trade balance figure for February, Germany's industrial orders rate for January, the UK's Halifax house prices rate for February, the US weekly initial jobless claims figure, and Canada's trade balance figure for January. On a busy Friday, we begin with Japan's current account balance for January, Germany's industrial output rate, and Sweden's GDP rate, both for the month of January, followed by the Eurozone's final GDP rate for Q4 of 2023, and the highlight of the week, which is the US employment data for February, and ending of the week is Canada's employment data also for February. The USD is about to end the week slightly high against the euro and the JPY, yet remained relatively unchanged against the pound. On a fundamental level, we know that the majority of political commentators now appear to be anticipating a November showdown between incumbent President Biden and former President Trump. On a monetary level, we note that concerns about inflationary pressures remaining entrenched in the US economy seem to be still on the minds of some Fed policymakers, which could support the USD. On a macroeconomic level, we note the favorite tool of the Fed for measuring inflationary pressures in the US economy, the core PCE price index, indicated easing inflationary pressures in the US economy, implying that the Fed's attempts to cool down the economy appear to be making their way through the economy, although some concern about the core PCE rate on a month-to-month level may prevent a declaration of victory just yet. Moreover, the second revision of the US GDP rate in Q4 2023 came in slightly lower than expected, and the stage is set for next week's employment data, which is anticipated to showcase an easing of the labor market, which could weigh on the US dollar. The pound seems to be edging lower against the US dollar, the euro, and JPY for the week. On a macroeconomic level, we note that this week was relatively easygoing for pound traders, as no major financial releases stemming from the UK were released. On a monetary level, we note the emergence of some hesitancy on behalf of the BOE to proceed with rate cuts even before the CPI rates drop below the bank's target of 2% year-on-year, as seen by BOE man's comments, which in turn could boost the GBP. For the time being, we note that the market still currently expects the bank to start cutting rates in August, but now expects a total of 2 rate cuts this year, down from 3 last week. On a fundamental level, we note that the UK's Finance Minister, Jeremy Hunt, is set to deliver the government's annual budget to Parliament, which is expected to include tax cuts in order to boost the economy. In such a scenario, the tax cuts could stimulate the economy, which in turn could provide support for the pound. JPY seems about to end the week unchanged against the US dollar, the euro, and the GBP. We note that on a macroeconomic level, the stabilization of the BOJ core CPI rate for January implied persistent inflationary pressures in the Japanese economy, which appears to be in line with the bank's 2% inflation target. Moreover, yen traders may be looking forward to Japan's Tokyo CPI rate for February on Tuesday to confirm the persistence of inflationary pressures in the Japanese economy. As such, on a monetary level, with the bank's inflation target now seemingly in sight, BOJ was sending mixed signals about its intentions. In our opinion, in order to be convinced that the bank is prepared to start normalizing its monetary policy during its April meeting, we would require a series of BOJ policymakers to release a series of statements in which they may imply that the bank is indeed ready for such a scenario. In the coming week, we highlight the release of the aforementioned Tokyo CPI rates for February, the speech by BOJ Governor Weda, and lastly, Japan's current account goods figure for January. The euro had little movement against the dollar and the pound, as well as against the yen for the week. On a macroeconomic level, we note that inflationary pressures appear to be easing in the eurozone, which in turn could weaken ECB's bank's resolve to maintain interest rates higher for longer. As such, on a monetary level, market participants may be eyeing next week's interest rate decision by the ECB, where Euro OIS currently implies a 93.7% probability for the bank to remain on hold at 4.5%. In our view, we agree with the market's expectations that the bank may remain on hold, yet we maintain the view that the bank's accompanying statement may slightly push back against current market expectations for a rate cut in June. In such a scenario, we may see the euro gaining, whereas should the bank cut rates or its accompanying statement appears to be dovish, it could weigh on the common currency considerably. In the coming week, we note the Eurozone Sendex figure, Germany's industrial orders rate, and the Eurozone's final GDP rate for Q4, which should it come in lower than expected, it could strengthen market expectations for a rate cut by June and thus may weigh on the euro and vice versa. AUD is about to end the week weaker against the US dollar, bringing an end to its 3-week winning streak and surrendering last week's gains. On a fundamental level, we note that the Aussies commodity currency nature tends to make it sensitive to the market sentiment and particularly to developments in China, given their close economic ties. On a macroeconomic level, China's MBS and extreme manufacturing PMI figures for February tended to highlight that Chinese factories are still struggling to increase their activities and as such could have negative implications for the Aussie. Moreover, adding to Australia's woes was the retail sales rate for January, which despite turning positive, failed to meet expectations, implying that the Australian consumer may be feeling the impact of the credit crunch due to high interest rates. Furthermore, the CPI rates for January did not showcase the expected acceleration in inflation and as such could ease pressure on the RBA to remain hawkish, which could further weigh on the Aussie. For next week, we highlight the release of Australia's GDP rate for Q4, which should it come in higher than the previous rate of 2.1%, it may provide support for the Aussie as a potential risk of a resurfacing in inflationary pressures could pressure the RBA to maintain its hawkish stance and vice versa. The loonie is about to end the week in the reds for a 9th week in a row against the US dollar. On a fundamental level, we note the sensitivity of the CAD to the market sentiment as a commodity currency. The positive correlation of the CAD with oil prices appears to have diverged this week despite Canada's status as a major oil-producing economy. Oil prices this week tended to gain support following reports that OPEC Plus was considering to further extend its voluntary oil production cuts, yet the loonie does not appear to have gotten the memo. Moreover, Canada's GDP rates for December sent out mixed signals, with the month-on-month rate coming in lower than expected at stagnation levels, whilst on an annualized quarter-on-quarter basis for Q4, the GDP rate accelerated by 1%, escaping negative territory, thus reducing concerns about a possible recession. Overall, it reacted positively to the release of the GDP rates, thus finding some strength as the week comes to a close. On a monetary level, we note the BOC's interest rate decision, which is due to take place next Wednesday, with CAD OIS implying currently an 85% probability for the bank to remain on hold, with the remaining 15% being attributed to a potential rate cut by the bank. And should the bank appear to be hawkish in nature in its accompanying statement, we may see the loonie gaining some support. Overall, in the coming week in the FX market, we expect heightened volatility as high-impact financial releases are stemming from various economies. On the other hand, US stock markets rallied yesterday with the S&P 500, Nasdaq 100 and the Dow Jones taking aim for the recently formed all-time highs. However, on a weekly basis, the Dow Jones is on track to end the week in the reds, a divergence from the other indexes. Nonetheless, should the positive market sentiment be maintained, we may see US stock markets printing new all-time highs in the coming week. Also note that the earnings season seems to be more or less done. Furthermore, also gold's price seems to be on track to end for a second week in a row in the greens against the US dollar. Moreover, the decline of US yields tended to support the precious metals price. Last but not least, a small fundamental note regarding recent political commentary made about a possible armed confrontation between Europe and NATO against Russia could funnel safe haven inflows into gold and lead to elevated tensions in the coming week. We hope that you found this report useful. From all of us here at IronFX, best wishes for solid trading.
Okay, so as per usual, before we get started, just a risk warning. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer: the information in this webinar should not be construed as investment advice or an investment recommendation, but instead educational material only. This material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. And today we're going to be talking about IC trading. IC trading, yeah. So this is a trading strategy that is pretty unique. So here's our agenda for today. We'll talk about what exactly it is and then get into some of the key concepts, followed by understanding what exactly it is and how you can make use of it. And then we'll look at what smart money looks like in price action. So if you guys have any questions throughout the webinar, feel free to pop a question into the chat and I will be happy to answer them. Okay, let's go ahead and get started. So what is ICT? So basically ICT stands for inner circle trading. Okay, let me just allow you to pop your questions into the chat. Okay, so let's start by defining what exactly we mean by inner circle trading. So ICT, or inner circle trading, is a trading methodology that focuses on understanding the inner workings of the financial markets. So it involves analyzing market dynamics, identifying supply and demand zones, and utilizing price action analysis to make informed trading decisions. So it has now grown to become one of the most popular trading strategies around, focusing instead solely on price action. And it was originally created by Michael Huddleston to trade the Forex market, but currently traders are using the same strategies to make profit in all and any market that they trade. So, yeah. So why exactly is it important for us to understand what ICT is? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give you a significant edge as traders. So by mastering the ICT techniques, you can enhance your ability to identify high probability trading opportunities and effectively manage your risk. So what exactly it is basically employing chart technical analysis and operates under the premise that by studying price movements, support and resistance levels, and order blocks, one can to some extent pinpoint the areas with the highest liquidity concentration and consequently forecast emerging trends. Okay, so let's get into some of the key concepts. Okay, so firstly, for our key concepts, we'll go through liquidity, followed by displacement, market structure shift, inducement, fair value gap, optimal trade entry, and lastly, balance price range or order block. So these are the fundamentals that you need to know in order to take advantage of trading in this style. So first key concept we'll go through is liquidity. So there are basically two types of liquidity. There's the buy side and sell side. So firstly, buy side liquidity represents a level on the chart where short sellers will have their stops positioned. So sell side liquidity is just the opposite of that. So it represents a level on the chart where long bias traders will place their stops. In both cases, these levels are found at or near extremes, as the tops and bottoms of ranges are often viewed where traders are proven wrong and therefore will want to get out of their trades. So here's an example. So smart money players understand the nature of this concept and commonly will accumulate or distribute positions near levels where mini stops reside. So you can see here, our sell side is on the bottom where the swing lows are, buy side is where the swing highs are. So basically it's where your resistance and your support levels are. So it is in part the sheer amount of stops at key levels, like those that I've just identified on this chart, that allow a larger player to fully realize their position. So once the level at which many stops are placed has been traded through, it's often that the price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. Okay, so you can see normally at these resistance levels, you would expect price to reverse off of these levels. Similarly, for your support levels, you would expect price to bounce off of those levels as well. So that's just basically what we are trying to say over here. Okay, next, let's look at displacement. So displacement in short is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have large real bodies, so you can see in the image here, your strong selling pressure would look like these candlesticks here, which have large real bodies, very short wicks, like you can see here, and that kind of suggests that there is very little disagreement between buyers and sellers. And if we are looking at strong buying pressure, like the one we see over here, similarly, you see that the body of a candlestick is long, whereas the candle wicks are pretty short. So a displacement will normally occur just after a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. So we'll get into what those mean in a little bit. But basically what it means when we say a displacement occurs after a liquidity level has been breached is if you look at this area here, this is a multiple swing low support level. You can see price has recently broke out of that level. If you can imagine this horizontal line just over here. So it's broken out of it and is reversing off it now. And that is what is resulting in a strong buying pressure. So that's just basically what it means by a liquidity level has been breached. So if you think about it as what we've been going through normally, which is through your support and resistance levels, it's pretty easy to catch. But let me know if you guys have any questions so far. Okay, if not, let's move on to the next key concept, which is a market structure shift. So there are two major market structure shifts. It's just another way of saying it's a trend. So we have an uptrend, which is when the price is making higher highs and higher lows, and a downtrend in which the price is making lower highs and lower lows. So it's pretty straightforward, but if we are referring to something that we talked about previously, um, you can see in this example, we have swing lows. Yeah. So these sessions are recorded. I think they will be uploaded onto YouTube, but I'm not too sure. You can email IronFX. I think the email is on their website. So let me just check. But yeah, you should, if you email them, I think they will be able to send you the recording, or at least give you the link to the right place. Let me see if I can find the email. Okay, I think if you go onto the ironfx.com website, you can just email them over here, support@ironfx.com. And I think they'll probably send you the link to this recording. Okay, sure, no worries. Okay, so where were we? Yeah, so when you're looking at market structure shift, it's important to find a market structure that has very clear movements in price. So if you look at the GIF that I've included here, there's a very clear price movement with swing highs and lows that are really significant. Okay, another example would be of a clear market structure. This isn't. Oh, let me go back to my slides. Okay, so this is the GIF that I was talking about earlier. So you can see that there are very clear movements in price with clear swing highs and very clear swing lows as well. If we look at this market structure, it's not as clear, but you can see that it's a very clear downtrend. So that's just basically what we're looking for over here. Okay, but typically we recommend you to look for a market structure that's clearer, something like this. Yeah, or something like this as well. So it doesn't have to follow a trend line. So over here you see that we have four um four swing highs that line up on this trend line. And it doesn't have to line up on a trend line. I'm just using this picture to show you what you can look out for. So here you see that we have um higher lows, or rather lower highs, since it's a downtrend. Okay, so next key concept we're looking at is the inducement. So rarely does the price move in a straight line. So within a larger trend, there are almost always counter trend moves. These counter trend moves are the results of lower time frame liquidity hunting. So let me show you an example. So if you see in this example where we have identified the market structure shift, it's basically when price has broken below this swing low. Okay, so that's a market structure shift. The inducement is when price has bounced off, which is over here, bounced off and is reversing off of a new resistance level. Okay, so the price will bounce or get rejected and then will target a previous short-term high or low before continuing in the same direction as the longer-term trend. So the short-term high in this case is here, all of the circles over here. Okay, and then it continues in the same direction. In this case, it's a downtrend in the longer term. So, yeah. So inducement is specifically targeting these short-term highs, like those that we've circled, or short-term highs or lows as areas where these stops might be placed. So because you're expecting price to reverse off of these circles, you might decide to place your stop loss right above these levels here. Okay. Okay, now next key concept we're looking at is the fair value gaps. So these are created within the displacement, and are defined as instances in which there are inefficiencies or imbalances in the market. So if we visualize what this means, it's basically a three-candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not overlap. So let me show you an example of this now. Okay, so if we look at the fair value gaps that have been filled, okay, you can see that these, if you follow the arrows, right, the fair value gaps are basically the levels in which price has retraced and is testing that level again. So it's basically what we previously mentioned as um, overlap resistance or support levels, or in this case, it's support overlap areas. Okay, so you see price reversing, testing that level, bouncing off of it. Similarly, price reverses, tested that level, and reversed off of it. And same thing over here. So in the example that I have here, the fair value gaps that are unfilled are basically the levels that don't reach that same level or the same areas from the previous price. Okay, I hope that makes sense, but you can just look at the chart, the example that I have here. Okay, so maybe to start off, you can look for what we've mentioned in the previous slide, which is the three candle sequence containing one large middle candle whose bordering candles upper and lower wicks do not overlap. So you can look for some of those examples in over here. Okay, so next let's look at optimal trade entry. So the optimal trade entry represents the best places to get into a trade, and they can be identified by utilizing the Fibonacci between 61.8 and 78.6. So maybe I'll show you an example. Our previous webinars recently were on Fibonacci, but if you missed that, I'll just briefly go through it here. Let me just pull out my, let me just show you guys a website. Okay, so if you missed our Fibonacci series, not to worry because we'll probably go through that again. But because we recently finished that, so it might be a while. But anyway, so the website that we recommend you to go through is theforexarmy.com, and it goes through how exactly to draw a Fibonacci retracement correctly. So there are some videos that you can take note of, the market structure to keep an eye out for. Okay, so if you're looking at using the ICT to find an optimal trade entry, they recommend to use a Fibonacci between 61.8 and 78.6. So although we typically use these levels, you would just be looking at these two levels here. And how that works is basically by looking at the highest starting point to the lowest, okay, or like something here. It shows you the invalid as well. Yeah, but you can just go ahead to this website and take a look. Okay, I think I'll just pop it into the chat. Oh, we have a question. Okay, what happens to FVG that has not been filled? So if we go back to my slides, basically what it means when it's not filled is that we don't expect price to return back to that area anytime soon. So we are not going to use those levels as, we're not going to take note of those levels. We want to take note of these FVGs that have been filled in order to place your stop losses and your take profit levels, yeah, according to those levels. Okay. I'll show you guys on TradingView, there is an indicator that helps you to find FVGs. So it's probably the easiest way to spot those, but I'll show you in a little bit. Okay. Yeah, I was talking about optimal trade entry. So the link that I've popped into the chat basically goes through the fundamentals of how to draw a Fibonacci, which I'll briefly go through here as well. So this is a Fibonacci retracement checklist. So firstly, you want to see is the market structure clear? So we showed you previously how to identify a clear market structure. Next, we want to look for the recent trend, so are prices going up or down, and it's important to always follow the general trend. Next, we want to identify recent major swing lows and swing highs, like those that we've identified previously, and then connect the two extreme points like we have done over here. So you're starting, since this is a downtrend, your starting point is at the swing high and your ending point is at the lowest swing low. Okay, here you can see all the different Fibonacci numbers that we mentioned in the previous slide. So for the ICT, we are focusing on 61.8 and 78.6. Okay, but it's basically the same thing. Here's another example. So we are looking at the level at which price bounces off either your 61.8 level or your 78.6 level. Okay, now let me get back to my... Okay, so after optimal trade entry, the next key concept is a balanced price range or imbalance. And this is the result of an aggressive move up that's immediately followed by an aggressive move down, or an aggressive move down that's immediately followed by an aggressive move up. For an uptrend, do we start the Fib 0 at the bottom or the top? Okay, I'll show you in a bit. Do I have it here? Yeah, so like something like over here, we would draw your starting point here and then your ending point would be here. So your 0% would be at the top. Okay, yeah, balanced price range. So what's left after either of these instances is essentially a double FVG or fair value gap, which can act as a magnet to the price before a continuation move higher or lower. So balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from those areas. Okay, so now let's look at what smart money looks like in price action. So SMC trading involves looking at order blocks, which is a refined version of supply and demand of an asset, and then your breaker block or mitigation blocks. This is what is traditionally called your support and resistance. flip zones, and then your FVGs, which are imbalances on the market. So when demand outpaces supply or vice versa. And then lastly, your liquidity gaps, which we went through before, are basically the areas in which there is a support level or a resistance level. Okay, now let me pull out my charts. Okay, so if we are looking at DXY, just a random chart, how you basically implement the FVG indicator, okay, is you go to the indicators, search for fair value gap, and this one. Okay, so this helps you to identify any of the FVGs. Okay, and you can use this on any time frame as well. So I'm on the 1 hour time frame now. Okay. Yeah. So the one that we use is the Luxel Gold one. This one here. This one. Lux Algo. So this automatically helps you to find FVG on any time frame, and it will help you to highlight the level as well. Okay. Okay, so you can actually use um these key concepts more as like a checklist when you're using the ICT trading strategy. So firstly, you look for the liquidity, followed by the displacement, look for any market structure shifts, inducements, value gaps, and then use your Fibonacci levels to find your optimal trade entry, followed by the balanced price range, which is basically looking for a double fair value gap over here. Okay, let's look at this example maybe. Okay, if I can find a double fair value gap, I'll show you as an example. But one of the websites we used, okay, let me just share that website with you. Because this is quite a niche trading strategy. So I'm just gonna share all the resources that we use. Um, So basically what I mean by a double fair value gap. So you can look at this website as well. But basically this is what we are looking at. Okay, so we have a balanced price range up here, which is essentially where price rebounds off of a resistance level. It drops and then it tests that level again. Here it says price testing and rejecting your VPR. Basically, if you were here for our support and resistance levels, we're just talking about a double swing high here. So it's just basically where the level is reversing off of that same level before, the same resistance level as before. Okay, and the reason why we are highlighting this entire area is because that's basically where we see price being attracted to. So it tends to be attracted to such areas and then reverses off of it. Okay, let me go back here. If we go back to the, yeah, to my chart here. So you can see that our fair value gap is in this area here. Okay, we have this green highlighted area, which is in line with this swing high. If we look at this fair value gap highlighted here, this is in line with this resistance area here as well. Okay, so we're expecting price to continue to rebound off of this area, and drop below it. So that's for resistance levels. We're looking at support levels. Here we have a swing, a couple of swing lows that match up with swing highs. Okay, so this is one swing low, two swing lows, and then a swing high, right? So this is a pretty significant level, and using your fair value gap basically helps you to highlight any of such areas. So like I mentioned earlier, these are not really specific levels, they're more so areas. Okay, and if we use, let's see if we can make use of our Fibonacci levels as well. Okay, here we see that we have a nice 38.2 that lines up nicely with this area. Okay, if I look at our 61.8 as well as the 78.6, okay, you can see that that also lines up with the highlighted fair value gaps over here, okay, as well as the 78.6 doesn't really, apart from this swing low, it doesn't really match up, which is fine. It doesn't always have to match up. So you can see that this 61.8 is a pretty significant level here. Okay, the reason why I say it's significant is because we have one swing low, two, 3, and 4 levels that are lining up. So we can expect price to be attracted to that area again and then bounce off of it. Okay. Yeah, I think that's all the time that we have for today. Again, so sorry for the delay because of the time mix-up. But yeah, let me know if you have any other questions. Um, yeah, for with regards to the recording, the email is on the IronFX website, and you can probably get the recording from them. And next week, we will be going through the second part of this ICT series. So yeah, stay tuned for that. Yep, I think next week we will start the usual time. So there won't be any scheduling mix-up again. Yeah, but so sorry about that. Thanks everyone. See you guys next week. Bye.